where are home prices expected to jump versus crash in 2026? The trend looks pretty different than the pandemic and the immediate aftermath of the pandemic. It's a different world today, real estate wise, at least if we're looking at single family home prices. So, Denny, do you have the list handy, or do you want me to do the honors of walking through the 10 cities with the highest projected home price growth in 2026?
Well, I I don't have the list handy, but I know there were, like Atlantic City, which is very close to me, was the
Was number
top,
one?
which completely surprised me.
And let's actually just pause for 1 second and say, so we used Zillow data to compile this list, and Zillow forecast data, and the actual top 10 cities on the list were like tiny towns that no one's ever heard of, so which are not particularly emblematic of larger real estate trends. So we picked out the 10 significant size cities, cities that you've heard of, cities that that can actually start playing out a trend for us to look at here. So without further ado, I will quickly read through the list of cities, and then we'll talk about the 10 cities with the greatest losses projected for 2026. And then we can talk about some of these trends because they are different from what we have seen in sort of the pandemic era. All right, so top 10 cities that Zillow projects to have the highest home price appreciation in 2026. Like Denny said, number one, Atlantic City, projected growth of 5.3%. Then Knoxville, Tennessee, 4.3% growth. Green Bay, Wisconsin at number 3 at 4.1% projected home price growth. At number 4, New Haven, Connecticut with 4.0% projected home price growth. Number 5, Hartford, Connecticut, projected growth of 3.9%. Number 6, Manchester, New Hampshire, projected growth at 3.8%. Number 7, Appleton, Wisconsin, projected growth at 3.7%. Number 8, Erie, Pennsylvania, 3.1% growth. Number 9, South Bend, Indiana, 2.9% growth. And number 10, Lexington, Kentucky, 2.8% projected growth. There are no super sexy, high growth Sunbelt cities on that list, right? As a right off the bat kind of, analysis. Now, there are a couple ones that are in the South there, but they're not the ones that have been, all over the news in the last 5 years for huge home price growth. Most of those cities are like Rust Belt cities in the Midwest, in the Northeast. Most of them are just consistent fundamentals kind of cities, where home prices never got too far out ahead of the local fundamentals of income and the local economy.
But I have to interject again about the Atlantic City, because I don't know if you knew, but Atlantic City really got hit bad after the pandemic. And they lost a lot of the casinos are obviously their number one bring in, and they lost a lot. So I know they are recovering a bit, but online gambling has really impacted them as well.
Sure.
So it was interesting to me and kind of nice to see that they're back on the list. So yeah, I just found that interesting.
Yeah, well, absolutely. And a lot of these cities, I mean, these are not cities that shot up during the pandemic, right? I mean, these are cities that have been kind of slow and steady, or like you said, in some cases declined during the pandemic. And then now you're seeing sort of the recovery or the consistent kind of growth among these cities. All right, let's switch gears for 1 second and contrast those with the cities that Zillow forecasts to have the greatest losses in 2026. So, number 1, New Orleans, Louisiana. Number 2, Shreveport, Louisiana. Oh, and by the way, New Orleans projected losses of 4.7%. Shreveport projected losses of 4.3%. Number 3, Fairbanks, Alaska, projected home price decline of 3.2%. Number 4, Austin, Texas, negative 2.6%. Number 5, Corpus Christi, Texas, negative 2.4%. San Francisco at number 6, negative 2.2%. Number 7, Denver, Colorado, negative 1.3%. Number 8, Cheyenne, Wyoming, negative 1.1%. Number 9, Sacramento, California, negative 1.0%. And number 10, Colorado Springs, Colorado, negative 1.0%. So that's a pretty different looking list, right? These are a lot of cities either in the Mountain West or the Sun Belt, cities that had huge home price jumps in the pandemic and in the immediate aftermath of the pandemic. A lot of them were, pandemic darling cities, where home prices just got out too far ahead of local fundamentals. And now we have seen a correction in those cities over the last 12 months, 18 months, and that correction is continuing through 2026. So, that trend is projected to continue through next year, through this year.
I also think a lot of those locations have been impacted by weather, big time weather, which has definitely increased costs, and it caused people to want to, get out of there.
That's a great point. That is another one of the trends we've seen over the last 3 years or so is homeowners insurance costs just skyrocketing, all over the country, but especially to your point, along the Gulf Coast, along the Mountain West where the fires are a big risk, and a little less, in the Southeast as well, along the Atlantic coast there. But yeah, no, it's a great point that when homeowners insurance rates skyrocket, that reduces the affordability. It reduces the amount that people can afford to spend on the actual home price, right?
Right.
Because people have a certain amount of money they can budget each month towards their home, towards housing. And if a bunch of it gets eaten up by homeowners insurance, that leaves less for them to pay for the actual principal and interest on their mortgage. So it's a great point that these are cities that have seen a lot of insurance growth over the last year, or the last 3 years, really.
Wasn't it odd to see Alaska on the list?
Well,
To me, it was...
that sounds like kind of an outlier, frankly. Yeah, that one seems like a bit of an outlier, but yeah, I mean, sort of blue collar Rust Belt cities that never got, never went up too much in home price. They are still continuing to grow and see home price appreciation, both over this past year and in the coming 12 months. And, it's really these cities that are projected to have the biggest price declines. These were a lot of them were pandemic darlings, pandemic boom towns that just flew too high. They flew too close to the sun, right? Like Icarus, and now the wings melted and they're coming back down to earth. So, a couple other, just trends worth mentioning in 2026. Interest rates are projected to remain above 6%. For mortgages. So, not expected to see any fireworks there as far as like mortgage rates driving home prices high, like lower rates driving home prices higher. No housing economists are really expecting to see a whole lot of movement there. However, new housing starts are projected to be at the lowest level since before the pandemic. So that does impact, that is a tailwind for home prices. And, and at least, even in some of those overbuilt markets in the Sun Belt, that will help reduce some of the drag on home prices there. There were, in a lot of markets, there were record high deliveries in 2024 and or 2025. So, big supply booms just dragging down home price growth in those markets. Or the flip side of that is keeping them affordable, right? I mean, that's the other, or helping with affordability if you're a buyer. So yeah, just, another trend to kind of keep an eye on. So Denny, let's talk about how you and I have been investing over the last year and plan to continue investing in, over the next 12 months.
I just want to interject one quick before we get into that. And I one of the things we do in the club is diversify. And I think that we can't time the market. You say that all the time. And this shows you that you can't time the market. Anyway, you go ahead.
No, it's a great point. And it's a refrain that, I feel like maybe we're just constantly parroting, but it's very true. And we say it all the time because it is one of our core values. Don't try to time the market. Don't get cute. Don't get clever. So we, in our co-investing club, we practice dollar cost averaging, where every month we are investing in a new passive real estate investment, with a relatively small amount, that makes dollar cost averaging actually possible, as opposed to going out and buying a rental property every month, or, investing in a new syndication by yourself every month, where you're going to need 50 grand or 100 grand. Very few people earn enough money to invest 50 grand every month, right? So, but yeah, so in our co-investing club, the minimum investment is 5 grand, which is not nothing, but it's much more manageable for, monthly dollar cost averaging, or every other month, or every quarter, or, whatever it is that any of our members, happen to be able to afford. So yeah, that is a big part of it. And then the other piece of it too, that is related to your point, Denny, is not trying to get cute in predicting the next hot market, right? The next hot city. That's a losing proposition. It's a losing battle. I mean, just speaking from personal experience, every time that I've tried to get clever in my investments, whether we're talking about stock investments or real estate investments, and try to like time the market or pick the next hot city, or whatever it is, the universe has just shoved a big slice of humble pie down my throat. And even in the times when I was ultimately right, I still ended up losing money because I got in too early, or a little too late, or whatever. Like even when like sort of the macro trend that I was spotting, I was like, oh, this is moving in that direction, I should get in. Well, there have been times when I got in too early and still lost money, right? Like, where there was a peak and then a crash, and then there was the big wave that came. But by that point, I had already been wiped out of those positions. So yeah, don't get clever, don't get cute with your investments. So yeah, to your point, Jenny, we do not try to pick the next hot city. We spread our money across many, many different states and cities across the country, knowing that sometimes we're going to hit on a city that is in the process of booming, and other times maybe it's just a slow and steady city, which is fine too, or maybe we buy into a city that is not going anywhere anytime soon. Hopefully it still generates good cash flow, right? But
Or types of properties, mobile homes, trailers, they tend to be pretty steady, especially in a poor market.
yeah, and in some cases, some of those investments, even when they don't like spike upward, maybe they have better downside protection in the event of a recession, like you just mentioned. So, so we try to encourage all of our investment club members, don't get cute with this stuff. Like, don't try to pick the next big boom town. And when you do get into a boom town, they tend to crash back down to earth, right? Like we just talked about. So anyway, here's how we are investing in our co-investing club, and how we have really been investing over the last 18 months and plan to continue investing. So stable, income-oriented multifamily properties, that is a core of our investing strategy. Especially in the Midwest, as a case study or a quick example, the deal that we did, the investment that we made in the month that we're recording this, it was an 180 unit multifamily property in a town called Mansfield, Ohio. And, it's a town that it's not winning any sexiness awards, right? Like, it's not Rio de Janeiro. But, it's a just slow and steady growth kind of market, very stable. No new housing supply has been added. And I can't remember what the operator said, something like 6 years since the last multifamily property was built there. But so strong occupancy rates. There's no new supply coming in to add competition. Very high cash flow yield on that property. I think we're projected to earn over 9% in the first year alone in cash flow yield, and then it's just projected to get higher from there. As they keep stabilizing it. So again, it's workforce housing, and this is just one example. But Midwestern. Rust Belt kind of town, very, very steady population, low vacancy rates, high occupancy rates in the property or in the town. There's no new supply coming in. No fireworks, but just steady growth, steady cash flow. There will be some profits on the back end. Knock on wood. But this is really an income oriented investment, and that's totally fine. So anyway, that's just one quick example, but yeah, these sorts of investments, income-oriented properties, stable markets, we like that stuff. diverse cities. We already touched on that, but spreading money across a lot of diverse markets around the country. We're big on that. We
Even
do
land.
land. Yep. We like we like land investments, and we've invested. I think over the last year, I think we invested with 3 different land operators actually. Each of
I know,
the
just to bring this, I mean, Atlantic City, one of the things that they don't have is land. So you're not going to see anything more built. So there's going to be scarcity, which is going to increase the value.
yeah. So I mean, and the land investors who we have invested in our co-investing club, they each have their own kind of niche strategy. They're each investing in different markets around the country. One of them, so he does some traditional land flips, but he also does, he'll buy a parcel and then he will install a manufactured home on it, and then sell it to home buyers, first-time home buyers, retail. And the average price that he's selling those for is literally half. It's 50% of the local area median home price. So, even in a recession, there's always going to be demand for half price homes, right? I mean, that demand is not going away. So, yeah, we like land. The other nice thing about land is that even operators who are just doing straight up flips for land parcels, the turnaround time on those is so fast that they can adapt even as real estate markets shift. So if even we've seen some real estate markets, lose value, over the last year. Some of them have seen declining, either declining home prices, or property values, or just flatline growth. And land flippers, the turnaround time for them is so fast that they can adjust their buying bids downward as the market is shifting downward. So even then they're not as exposed as house flippers, where there's a longer turnaround time. There's more of that, the material investments and so forth. And each parcel is relatively inexpensive with land typically. So anyway, not to go down a rabbit hole of land, but we've done some industrial seller leaseback deals, which are kind of a niche thing, but we've seen a lot of success with those. There's a way of doing them conservatively, and we obviously we look for operators who follow a very conservative business model with that. But part of that is making sure that even in the worst case scenario, even if the industrial tenant defaults and has to be removed from the industrial property, that the market value of that property and the local demand is such that they can install a new industrial tenant there, paying more per square foot than what the original tenant was paying. And of course, half of that due diligence that they do is making sure that the original tenant, the leaseback tenant, is very stable, has enormous cash reserves, has been in business for, in the cases we've invested in, like decades. These businesses have been not only in business for decades, but at that location for decades. And
right. I think one even has government contracts, which is kind of helpful.
Yeah, I mean, one of those, their largest client was actually the U.S. Navy, and that particular company, they had a 3-year backlog of orders, so they weren't going anywhere, right? Is the point? But even if they did, even if something catastrophic happened and they did default on the lease, the operator could put a new industrial tenant in there, paying more. So anyway, like so we like some of those deals, and we'll keep looking at other investments as well. I mean, we're big on diversification in the co-investing club. So, lots of different types of, asset types with properties, different geographical markets, different operators, of course, different investment timelines. We like to do a mix, not just the longer term syndications, but also some shorter term stuff as well to keep that investment timeline staggered. That's another form of diversification. Denny, anything you want to add about these cities or about, trends that you're seeing, through 2026?
I just have I want to get your opinion on something. This new possibly 50-year mortgage. Do you think that would impact some of these locations in good or bad?
Oh man, we could do an entire episode.
Is that another show?
There's a whole episode to be had about that. That is really, that would benefit sellers I mean, that's ultimately just going to drive the price up of homes because buyers can afford to spend more at the same monthly cost, and most home buyers are buying with a mortgage. So they're pricing their bids based on the monthly cost of ownership. So, I think that is mostly downside for buyers, not really an upside. I think and it's all upside for sellers, who just get a quick, inflated boost to their home prices. But there's a lot to unpack there. I mean, to me, it reeks of like an attempt at a quick political win as opposed to something that's actually good for our long-term economy and housing markets. But, I certainly don't want to go down that rabbit hole. So anyway, Denny, do you have any thoughts you want to share on that?
No, I can see exactly what you said, but my point was, would that help some of the locations that aren't doing well now? If that were to go into place, would it actually increase their values, make their values go up? And I personally believe that it probably would, to a degree.
So I can't remember who it was. I wrote an article about this. I don't know, a month or so back, and I got some quotes from economists about that article, and wanted to hear, real estate economists in particular, wanted to hear their thoughts on it. And this one economist was saying that she thinks that this will kind of separate the haves and the have-not cities more, because cities that are already super affordable, this is, they're struggling to fill houses, right? Like the affordability is not the problem there. So this is not going to really help with affordability in those cities because they're already super affordable. Cities like San Francisco, for example, where the median home price is like $1.25 million, it was just going to boost their home prices that much more because now people can spread out their mortgages that much longer.
Wow, okay.
So it will incentivize people to make bids and move to those cities even more, those high flying cities. So it's not going to really help the cities like Cleveland, for example, but it will make cities like San Francisco that much more expensive. But then ultimately that comes full circle back around, and if the affordability differential gets wider, which this economist she was saying that it would, and I think I buy her argument. I think she's onto something here. Then eventually that will come back and redistribute people back to those affordability markets again after that initial divergence. So you'll see that initial divergence, like driving the affordability gap even further, in maybe the first 5 years or whatever. But eventually, that pendulum will kind of swing back around, and people will say, all right, well, the affordability has gotten stretched way too thin again in these super expensive cities. Like, I'm out of here. I'm moving back to Cleveland. You know what I mean? Or I'm moving to a more affordable market. So, I mean, she was kind of making that like rubber band argument that it's going to stretch that affordability gap even further. But then eventually that rubber band will probably snap back. So anyway.
Didn't mean to go off on that tangent, but I think it's interesting because it is something that could happen.
Yeah, well, we'll see. We'll see how that all unfolds. But on that note, guys, if you got a fresh perspective from this episode, subscribe to the show, pass it along, share it with friends, family members, neighbors, cousins twice removed, and email us, support@sparkrental.com. Let us know what you want to hear more of, less of, all that good stuff. And if you're new to the idea of passive real estate investing, because most people are, we have a free course on it. So sparkrental.com/free. Check it out and stay weird, unconventional investor.